Alex sat in the parking lot of a gas station off Interstate 85 in Charlotte, North Carolina. His back ached. His hands were stained with black engine grease and silver anti-seize paste that never quite came out from under his fingernails, no matter how hard he scrubbed. He pulled up his mobile banking app on his phone. The screen flickered in the dark cab. $100,214.88. He stared at the six figures. He didn't cheer. He didn't call anyone. He just let his head drop back against the cracked vinyl headrest and breathed out a breath he felt like he'd been holding for 4 straight years. 4 years of starting an HVAC business with nothing but a used truck, a Harbor Freight toolbox, and a state license. No venture capital, no trust fund, no loan from his parents. Just 80-hour weeks, crawling under houses in July heat and eating cold gas station sandwiches while looking at electrical schematics. He whispered it out loud into the quiet cabin of the truck. I made it. He was wrong. He wasn't wrong about the number on the screen. The money was real. He was wrong about what that number actually meant. Alex believed what almost every ambitious person starting from zero believes, that reaching $100,000 is the hard part. The finish line. The moment you transition from surviving to wealthy. What nobody tells you, what the motivational speakers and financial gurus skip over, is that reaching $100,000 doesn't make you safe. It puts a target on your back. It triggers a psychological trap designed to strip that money away from you faster than you earned it. Over the next 24 months, Alex wouldn't just face economic bad luck. He would face 3 distinct tests disguised as opportunities that almost wiped out everything he'd built. This isn't the story of how Alex made his first $100,000. This is the story of how he almost lost it and the invisible rules of wealth that saved him.
Exclusive to True Tongues.
To understand why $100,000 is so dangerous, you have to understand what it does to your brain. Alex was obsessed with financial podcasts. On long drives between service calls in Concord and Gastonia, he would listen to old audio clips of legendary investors. One idea stuck with him above all others, something Charlie Munger, the late billionaire business partner of Warren Buffett, once told a room of Berkshire Hathaway shareholders. That your first $100,000 is brutally hard to reach if you're starting from nothing, and once you have it, you can finally ease off the intensity a little. Alex internalized that like scripture. He believed $100,000 was a magical threshold where compounding takes over and does the heavy lifting for you. And mathematically, Munger wasn't wrong. Going from $0 to $100,000 purely through earned income and brutal saving is the steepest hill you will ever climb. To get there, Alex had underbid competitors just to win contracts, worked Saturdays, slept in his truck between emergency service calls, and denied himself virtually every luxury. But Alex missed the hidden footnote in that idea. The snowball only rolls down the hill automatically if you leave it alone. The moment you touch it, the moment you try to reshape it, show it off, or speed it up, it shatters. When Alex reached $100,000, his brain didn't register it as a foundation. His brain registered it as a finish line. And when your mind thinks it has crossed the finish line, the intensity that got you there disappears instantly. The first threat to Alex's wealth didn't come from a market crash. It came from a subtle psychological mechanism that strikes almost everyone the moment they achieve a financial goal. It started 3 weeks after that night at the gas station. Alex was sitting at a stoplight when his old truck shuddered, choked, and spat a cloud of gray smoke from the exhaust. It had 194,000 miles on it. The air conditioning was shot ironic for an HVAC technician, and the driver's side door handle had to be jiggled in a very specific way to open. For 4 years, Alex had worn those flaws like a badge of honor, but now he looked down at his phone. He had $100,000 in the bank. I'm running a legitimate business. he told himself. What kind of image am I projecting arriving at a high-end customer's house in a beaten-up rig? That afternoon, he walked into a dealership. He didn't buy a modest, reliable used vehicle. He signed the papers on a late model, fully loaded crew cab pickup. Monthly payment, $680. Next came the apartment. For years, he'd lived in a cramped, dark one-bedroom unit near the highway where the train woke him up at 3 a.m. He moved to a luxury complex closer to downtown Charlotte. Modern kitchen, gym, garage for his gear. Rent increase, $350 a month. Then came the tools. He swapped out his old reliable gear for top-of-the-line brushless power tools and digital manifold gauges. Cost, $1,200 outright. If you asked Alex in that moment, he had a perfectly rational, business-minded defense for every single expense. The truck was for brand image, the apartment was for space to do invoicing, the tools were for efficiency. Psychologists have a term for this: moral licensing. When you demonstrate extreme self-control over a prolonged period, like grinding for 4 years to save 6 figures, your subconscious brain feels it has accumulated a massive balance of good behavior. 2. Balance the scales. Your brain quietly gives you permission to loosen up. You tell yourself, I've earned this. Here is the terrifying math of, I've earned this. Alex's lifestyle upgrades added roughly $1,100 a month in recurring overhead. To a man with $100,000 in savings, $1,100 a month felt like pocket change. It felt harmless. But let's look at what that $1,100 actually cost him. If Alex had taken that same $1,100 a month and invested it into a standard index fund, yielding an average 8% annual return, over 20 years that money would have grown to over $650,000. Alex didn't just spend $1,100 a month on upgrades. He traded away over $500,000 of future freedom so he could feel successful in the present. He didn't lose his money in a sudden catastrophe. He was leaking it out through the floorboards of his life, one defensible purchase at a time. 6 months after crossing the $100,000 mark, Alex met a man named Marcus at an equipment supplier's warehouse in North Charlotte. Marcus was older, drove a BMW, and talked fast. He was a small-scale real estate developer who bought distressed residential properties, renovated them, and flipped them. Over a cup of stale industrial coffee, Marcus laid a blueprint out on the counter. "Look at this house in Gastonia," Marcus said, pointing at a photograph of a rundown ranch-style home. "I can buy this off-market for $140,000. It needs $40,000 in work. It'll appraise for $250,000 all day long. I've got 2 guys funding it, but I need $35,000 to close the gap on the hard money loan. I'll give you a 15% guaranteed return in 6 months. 4 years ago, if someone had asked Alex for $35,000, he would have laughed. He didn't have it. But now, he had the capital sitting right there in his savings account, earning a measly 1% interest. And more importantly, Alex had developed a dangerous asset: overconfidence. When you pull off something hard like building a business from zero, it creates an illusion of competence. You start to believe that because you are good at your specific skill, you are automatically good at all financial decisions. You feel like the standard rules of risk no longer apply to you. Alex went home that night and stared at his screen. $35,000 was roughly 1/3 of his total life savings. If Marcus's deal worked, Alex would make over $5,000 in passive profit in 180 days without wiping down a single condenser coil. He pulled out his laptop and drafted the transfer memo. He was 5 minutes away from clicking send when his phone rang. It was his mentor, a retired contractor named Dave, who had sold his business a decade earlier and lived a quiet, comfortable life. Alex had called him earlier that week to brag slightly about the opportunity. Dave didn't ask about the interest rate. He didn't ask about the property address. He asked one simple question. Alex, if that project goes sideways and Marcus defaults, do you have the legal budget and the time to foreclose on him and take the house? Alex paused. Well, no. Marcus is a good guy. He does this all the time. Dave's voice went cold over the receiver. He told Alex plainly that $35,000 wasn't ammunition to fire at shiny objects. It was the concrete foundation under his house, and you don't chip away at a foundation to build the roof faster. Risking a third of his life savings on a deal he had zero control over didn't make him an investor. It made him a gambler who'd gotten lucky so far. The words stung. Alex's ego flared up, but he respected Dave enough to close the laptop. He told Marcus he was passing on the deal. 8 months later, the real estate market cooled slightly in that submarket. Supply costs exploded. Marcus's contractor ran off with the renovation budget. The house went into default, and the hard money lender seized the asset. The secondary investors, the ones who put up the gap funding, were completely wiped out. Alex had survived his second test, not because he was smart enough to analyze the real estate deal, but because he listened to a fundamental financial rule. Never risk foundational money on assets you do not control. By month 14, after reaching $100,000, Alex felt like he was back on stable ground. He had avoided Marcus's bad deal. He was keeping his head down. Then, November hit. In the HVAC industry, late autumn and early spring are known as the shoulder seasons. It's not hot enough for air conditioning, and it's not cold enough for heavy heating. Business slows down naturally. Except this November wasn't just slow, it was dead. For 3 straight weeks, the phone barely rang. Alex was paying his fixed shop overhead, his shop insurance, his high rent on his new apartment, and the $680 truck payment out of his business cash flow. For the first time in years, his business operated at a net loss for the month. Then came Tuesday, November 18th. Alex was driving back from a rare commercial service call when the engine on his primary service van, the one his employee drove, made a violent grinding noise, followed by a loud bang. The transmission didn't just slip, it completely disintegrated. Repair quote, $6,800. 2 days later, his commercial liability insurance policy was up for renewal. Premium increase due to local rate adjustments, $3,200 upfront. Total unexpected outflow in 48 hours, $10,000. During a month where he had made almost zero revenue. This is the exact moment where most small business owners panic. When income drops and expenses spike simultaneously, people without savings do destructive things. High-interest merchant cash advances, company expenses on personal credit cards at 24% interest, or panic selling investments at the worst possible time. Alex opened his bank account. If he hadn't built a buffer, this $10,000 hit would have felt like a fatal blow. But 8 months earlier, following Dave's advice, Alex had split his capital into 2 distinct accounts. The Core Growth Fund, his non-negotiable $100,000 allocated for long-term investments, and the Operational Shock Absorber, a separate liquidity cushion equal to 3 months of business and living expenses. Alex wrote the check for the transmission. He paid the insurance premium. His long-term $100,000 balance didn't decrease by a single cent. This moment changed Alex's entire perspective on money. Wealth isn't just about buying power or luxury cars. Wealth is financial immunity, the ability to absorb life's inevitable bad weeks without having to alter your trajectory or sell off your future. You would think that after avoiding a bad real estate deal and surviving a severe business downturn, Alex would be invincible. He wasn't, because the most dangerous trap isn't the first mistake you make. It's the false sense of security that comes from avoiding the first mistake. In early 2026, Alex felt bulletproof. His business had recovered, his buffer was replenished, and he felt like he had mastered money. That's when an old friend from high school reached out. The friend wasn't a shady salesman like Marcus. He was a successful software engineer who had been involved early in an algorithmic cryptocurrency trading pool. He showed Alex his dashboard on his phone over dinner. Consistent 12% monthly returns, slick user interface, backed by early-stage venture capital metrics. "I'm only telling you because they're closing the private seed pool next week," his friend said. Minimum buy-in is 15 grand. Alex didn't call Dave this time. He didn't wait 72 hours to let his emotions cool. He felt smart. He felt experienced. He felt like he was in the loop. That night, at 11:30 p.m., sitting in his living room, Alex logged into his account and wired $15,000 into the platform. For 14 days, Alex was a genius. Every morning, he'd wake up, refresh the app, and watch his balance tick upward. $15,000 became $16,200, then $17,800. He felt the same adrenaline rush he felt when he reached $100,000 for the first time. On day 16, he woke up at 6 a.m., poured a cup of coffee, and tapped the app icon. The screen didn't load. It displayed an error code. He opened Twitter. He opened Reddit. The headline was everywhere. The yield protocol had suffered an exploit. The liquidity pool had been drained, and the founders had halted all withdrawals. 2 weeks later, after emergency restructuring, the platform released what was left of the remaining assets. Alex got $5,400 back. $9,600 was gone forever. Alex stood in his kitchen, staring at his screen. The loss didn't ruin him financially. He still had his baseline savings, but it shattered his pride. That $9,600 loss taught him something the near misses never could. Confidence is not expertise. Feeling like a genius during a good run is just luck hiding your bad habits. A few weeks after losing the $9,600, Alex drove home to visit his parents in rural North Carolina. His father was a man of few words. He had worked for 32 years on the assembly line at a manufacturing plant. He drove a 10-year-old Toyota Camry, wore simple clothes, and lived in a modest brick ranch house that had been fully paid off a decade ago. They sat on the back porch after dinner, listening to the crickets. Alex, still carrying the weight of his recent loss and the stress of managing his inflated lifestyle, admitted everything to his father: the $100,000, the new truck, the luxury apartment, the real estate temptation, the crypto loss. His father took a sip of coffee, looked out over the yard, and said something Alex wrote down in his notebook that night: that earning your first 100 grand takes hustle, but keeping it takes humility. The hardest part of actually having money isn't earning it, it's learning to act like you don't. He pointed out toward the driveway. He said Alex had bought that fancy truck because he wanted people to know he was doing well. But real wealth is what you don't see: the cars not bought, the upgrades not made, the flexes never posted. The people who stay rich aren't the ones showing off their stack. They're the ones who treat their money like an invisible wall between them and chaos. That night, Alex realized he had been using his money as a tool for validation rather than a tool for freedom. The next week, Alex made drastic changes. He subleased the luxury apartment and moved into a clean, simple 2-bedroom house with lower rent. He stopped looking for shortcuts and hyper-aggressive investments. He set up an automated system that transferred every spare dollar directly into low-cost, broad market index funds and his operational reserve. He stopped trying to look rich. He started focusing on becoming untouchable. Fast forward 2 years. It was a standard Tuesday afternoon. Alex was sitting in his office. He wasn't crawling through dirt under a house, and he wasn't stressing over late invoices. He opened his financial portfolio software. He looked at the total net worth column. It had crossed a brand new milestone far higher than that initial $100,000. But more importantly, he looked at the dividend and compound growth from the previous 12 months. His invested assets had generated more income over the past year than his entire business had made him during his first 2 years in operation. His money was officially outworking him. The skill that gets you to $100,000 and the skill that keeps you there are complete opposites. Alex never lost his $100,000 to a market crash. Almost nobody does. He came within minutes, or within one phone call, of losing it 3 separate times to a reward, a shortcut, and a sure thing that all felt completely reasonable walking into them. The first $100,000 was never the trap people think it is. Reaching it just rewards a different set of instincts than keeping it does. Nobody warns you that you have to unlearn the first set to survive the second. If you're closing in on your own 6 figures, or you've already crossed it, the real test was never the number on the screen. It's every ordinary decision after it.